Okay, we're starting this seminar or this webinar, excuse me, and over the years, I have been involved with the Millionaire Real Estate Investor book, which you can see the blue book there, and then when the market started to shift, lots of people were flipping properties, and that green book is about flipping properties. I wasn't involved in that particular book, but it's part of a series. It's part of a trilogy. And then the last part of the trilogy, I am one of the co-authors of the book, Hold, and that became a national bestseller a couple of years ago. And I continue to do seminars across the country, teaching people how to build wealth through holding on of real estate. And so if you haven't had the opportunity to read that book yet, it is available on Amazon. We're proud. We've got a 4.5-star rating, and interestingly, the only people that haven't given us a 5-star rating are the ones that are sophisticated investors and found out that and determined that we weren't sophisticated enough in the book, which is exactly what we wanted. We wanted it to be for people that were getting started in building wealth and had a few properties or maybe none. I've been an investor now and have worked with investors for over 35 years. And so this afternoon, I am pleased to share what's going on in the Phoenix market and what's happening in Phoenix. And so one of the things that I absolutely believe is that the ownership of investment real estate is the foundation for building wealth. And the purpose of the webinar is because we're here paying attention to it on a daily basis. And we know lots of people around the country that don't do that. So that's why we started doing these webinars. I think this is the third or fourth one that we've done so far this year in 2015. And I wanted to introduce you to the idea. If you've not heard the story of Ray Kroc, he's the man who started McDonald's hamburgers. And someone asked him one time about being in the hamburger business. And he said, I'm not in the hamburger business, I'm in the real estate business, and the hamburgers just pay for the real estate. So the other day in the Wall Street Journal, they had a graphic that showed what the McDonald's Corporation actually gets from the people, their franchisees. And if you take a look here, the bulk of the money that they make every year is 2009 through 2014. And the bulk of the money that they get is from the rent, from the real estate that they own. The royalties on the hamburgers and stuff that they sell is only half of what they make on the real estate. So even in back many, many years ago, Ray Kroc knew that the purpose of making money was to acquire assets like real estate, because that was the foundation for wealth. So let's talk about the Phoenix market just a little bit. And I believe that empowerment is knowing what's happening and knowing how to respond to what's going on. So the Phoenix market right now is very strong. It has been favorable for real estate investors, especially for the ones who purchased homes when the bottom fell out of the market. And prices have risen. Those investors have substantial equity. And I'll show you a couple of graphs here in a minute that demonstrates that. And so these people are what I call investors on purpose. It means they intended to purchase this property and they intended to rent it out when they bought it. And then there's others that own investment property or rental property, and I call them investors by default, because they meant to live in that property, and when it was time for them to move, the market did not allow them to sell it for a price where they could make money, so they decided, well, let's go ahead and rent it out until the market shifts. Well, either way, they became real estate investors. And it's important, I believe, it's important that it doesn't matter why you became an investor. The point is to maximize the return on investment from that particular asset that you have. So our goal today is to provide an overview, not only of where we've been, but also where we're going, so you know how to maximize the opportunities in this Phoenix market. So I've got a chart up here, and is there a delay, Autumn, or are things coming through the way we need them to?
It's looking good, Steve.
Okay, good. All right, so you can see here that this is the annual sales in the Phoenix area, and you can see that I've got my mouse over here on 2005, where we peaked with 100,000 properties that have sold annually. And of course, then the market went down to 2008 and started to climb back up. But you can see that the normal sales, which is the blue, this blue part here, the normal sales continued to go down. The number of sales went up because we had lots and lots of investors coming in from as Wall Street investors. And it's the first time actually in history that Wall Street put money together into hedge funds or other kinds of funds and invested in single family properties. And they knew with the prices down this far that, that there was equity to be made there. However, they didn't want to do, they did not do it as a short-term get-rich-quick play. They put renters into the properties. And so while the prices were low through 2009, 2010, 2011, and right in this area, they were buying up properties by the tens of thousands. Interestingly, because they had cash, they didn't have to worry about getting an appraisal. So if they found a property they want, they just bid the price up, which that made it difficult for the day-to-day investor like you and me to be involved in it. So if you notice this little red star over here, it made it difficult. Let me just finish that thought. It made it difficult because they were paying cash and paying more than the properties were worth at the time, because they knew that they were going to have a long-term hold and there was a big upside potential. So right here is this star is where the market shifted. And so we can see that the number of sales in the Phoenix area came down into 2014, and then it started back up again 2014 and all the way through 2015 so far. The other thing that happened was we saw, this is a chart that just shows how many trustee deeds are, and how many foreclosures were started every day. And you can see that the purple line was 2013, and it declined all the way through 2013. This blue line down here at the bottom is where we are right now. And so the foreclosures are only a minimal part of our market. And even the people that are in trouble, because a trustee deed is when it's filed, it takes 90 days for it to actually foreclose. So when the trustee deed is filed, it doesn't mean that it sells as a foreclosure. It means somebody probably picked it up as a distressed property, but there's there's fewer and fewer of them available all the time. Now let's take a big picture look. And if there's any questions, please go ahead and stop me. And I'm glad to explain anything as we go through this. Now, this is what we call the Cromford Index. And there's a man named Michael Orr who works for Arizona State University, and he's the head of the real estate department. And he's been keeping track of the market and what's going on in the market. And you can see here 2002 all the way till this year, 2015. And the black line that runs across the middle, that's when the market is in balance, which means it doesn't favor the buyers, it doesn't favor the sellers. The supply and the demand is in balance. And you can see that we've gone way up here in a market that favors the people that own properties. And down here, it favored the people that were buying properties and favored the buyers at that time. Look at 2014, 2015. We have, the market has been going up favoring property owners. And that means, quite frankly, that the sellers are in control and prices are starting to go up. Let me show you what happens. We're average, you can see here that this is just the East Valley cities. This is Mesa, Tempe, Chandler, Scottsdale, Fountain Hills, Queen Creek, the whole East Valley area. And you can see that, that between the black lines, this area right here is this year, 2015. And we've been trending upward all the way through this period of time as far as our average sales price is concerned. And so while we go back Well, so we're at our average sales price is at $287,000, but our median sales price is around $230,000. Those are affordable housing prices. And so I want to show you what's been happening in our market vis-a-vis appreciation of properties, because the people that, the investors that were investors by default, the ones that their property was upside down or they needed to rent the property instead of selling it, many of them were waiting for the market to come up, which you can see here, prices have been going up, and they've been bailing out and selling the properties now because they didn't really want to hold on to them as an investment. They felt forced to hold on to them. Let me show you what's happened here as far as price range is concerned. Here's the appreciation of properties based on sales price. So let's just take a look here at the sales price of 150 to 175. Typically, we would see Queen Creek, Santan Valley, Maricopa, places like that in that particular price range, 150 to 175. Those properties have gone up in the last year, or just this year, they've gone up 8%. Here's the sweet spot. The sweet spot for rental properties is between the $200,000 and $300,000 price point. Well, look at this, the appreciation at 6.7%. Here it's 1.9, 3.8. Here's almost 6% appreciation. And right now, this is where most of the people are looking to try and find investment properties, right here in the 200 to 225. And there's a shortage of properties on the market right now. They cannot find enough of them to meet the buyer demand. And just taking a look up here at the top, the properties over 3 million, they've actually gone down. The sales prices have actually gone down 20% over this past year, just because the supply and demand, there's lots of supply more than the demand. Any questions about this, please feel free to go ahead and ask. All right, now here's the other part of it that's happened. I've been talking about property values, but this is the average lease price per square foot. And I just want to show you here, we're going back a few years, and over 2011, 2012, 2013, right in this area, rents have been flat. But in 2014, we started to increase, and you can see the trend line going up even here to 2015, because our rental supply has decreased some. People have been selling the properties. The default investor have been selling their properties, and so now what was a rental property is now coming off the market. And there's a continued demand because the millennials have not been purchasing as many properties so the demand for buying properties has been slower, and they have been renting, many of them, because they've got debt and they can't qualify, or there's lots of different reasons. Good news, the point in all of this is rents are going up, sales prices are going up, our market is really strong here. Now, this is written by the man from ASU. I'm going to go ahead and read this screen to you. It says, "It is good for Phoenix. It is good for Phoenix that Arizona's economy is not dependent on the commodity and raw materials business. Our copper mines are in bad financial shape, with copper prices sinking ever lower due to weak demand from Asia. However, the biggest mines are owned by Mexican corporations these days, so it's not affecting our economy. The oil and gas business is likely to have some difficult months, if not years. But Phoenix housing market is not driven by the energy sector either. So a deflationary cycle in the energy sector it's talking about will make our homes look more expensive to foreigners, but our real estate market depends very little on demand from foreign countries. Canada has supplied most of the foreign home buyers in the past few years. But in the last 3 months, only 163 Maricopa County homes were purchased by Canadians. That compares with almost 1,498 in the peak of 2011. So this huge percentage drop has not caused any serious problems with our supply and demand, even though the Canadian demand is not likely to come back anytime soon. So what does all this mean? This means that we've got a strong growth environment here in Phoenix. Our property values are going up. And even though some sectors of the economy are not doing well, Phoenix is continuing to do well because we're not dependent on those issues. So Phoenix last year just passed Philadelphia to become the 5th largest city in the US. And we've been projected to add almost 100,000 in population each year, every year. That's a new small city moving into our area every year. And when people move into town, typically they rent for a year or two before they buy a property, and that's great news for the people who own the rental properties. So let's take a look at a couple of numbers here real quick, okay? This is Arizona's, the University of Arizona Economic Business Research Center. And they've been projecting in 2014, 2015 that we're going to continue to grow and add additional population. And they're averaging about 90,000 or 91,000 new people moving into our area. And that's a net population growth. That's great for somebody that owns property as a rental property. In addition to that, yes.
Steve, I lost the slide. Oh, I'm sorry, that's on my end. Okay. I'm sorry.
Oh, okay.
Okay.
All right, perfect. So this slide shows what's happened with new and resale homes. And if you look at the back side of this slide here with the blue dots, this would be the number that typically sold when we were in a really strong real estate market. We were typically selling about 3,500 to 4,000 houses per month. Then all of a sudden, for 7 years, the number is down, and we're talking about 500 new ones. We're bumping up here, and we're hoping that we get up to 1,200. I think this year they're hoping to get to about 1,400 or 1,600 new homes. I don't remember exactly the number. Here's the point. While our population has been growing every single year, we've not been building enough new homes to accommodate the population growth. So what that means is that the existing properties become more and more in demand. It also means that the new homes that are being built are further out, takes longer to drive into the employment centers, and so location is starting to drive values even more. I went out and looked this morning at a house in Tempe, and that house had under 900 square feet. And of course it needs to be fixed up, but I was looking at the comparable properties, and believe it or not, a 2-bedroom, 1-bath house with a single carport that's fixed up just sold for almost $200,000. Those kind of numbers, location, that's the reason it did. It's close to the employment center, it's close to the university, and so Phoenix has continued to grow and develop. And you can see at the bottom of this slide here, Forbes was predicting that we'll be the 4th most populous city, and that our population will be at $2.2 million, or excuse me, 2.2 million people. But our whole broad area will be a little over 6 million people in this area. So our market is strong, things are doing well. Let's just do a quick comparison this year over last year. The average asking rents in the Phoenix market in the MLS is up 6% over September of last year. And what we're seeing is that people that are fixing up the properties, they're modernizing them and making the properties in great condition, they're getting top rents. The rents are going up. We've seen that property values, and we've talked about it's 5 to 6% over the past year that it's gone up, and that the foreclosed properties, they're the lowest since 2008. Wall Street is out of our market, means the opportunities that are there are available for the everyday investor like you and me. Also, what's happening is there's few people in what we call the penalty box. And so in 2008, 2009, 2010, when people were losing their homes, if they lost a home to foreclosure, they had to wait 7 years before they can qualify for a loan. Well, we've hit the 7-year mark for the people that lost their properties in 2008. And that was the bottom of our market. Our market started to go down in 05, 06, 07. So people that had done a short sale in the past 4 years, they're starting to come out of the penalty box, which increases the demand for properties here in the Phoenix area. So we'll see, I think we're going to continue to see future appreciation. So the future looks really good for real estate investing here specifically. Now let's talk.
Excuse me, can I ask a question?
Yes, you can.
Okay, now similar to everything that's going on in China and the stock market, how do you feel that the presidential election will affect real estate?
Well, that's a really big question. Will the presidential election affect real estate? One of the things that that has been conventional wisdom over years and years and years is interest rates stay low in a presidential election year because they want the economy to do well and to be well. I don't know how they get much lower than they are right now. But I think that we're seeing with the stock market, for example, look on the screen right now, this is the Dow Jones Industrial Average for this year. And so here is the beginning of 2015, right in here. We're down 6% so far this year. So we are seeing people right now, they're taking their money out of the stock market and they're investing in real estate because there's a whole lot of people right now that are concerned. The stock market has been heavy into the Asian market. China's not doing well. It's been heavy into the European market. It's not doing well. The United States, as we've been growing very, very slowly, people are concerned that they're not going to be able to get the return on investment that they need for their money. However, they can get it in real estate. Let me share with you an example, okay? Imagine that you just purchased a property and you put $100,000 or 20% down, and you held that property for 20 years. And so 20 years later, it had a break-even cash flow. In other words, you didn't make any money out of it, but it didn't cost you anything because the tenant was making your payment for you and that kind of thing. And let's pretend that that property you sold 20 years later for $100,000, that it didn't appreciate a dime over that period of time. The return on investment, and by the way, most people would not sign up for that as an investment and say, this is what I owe, this is what I'm looking for. Yet the return on investment for that particular example is over 8% a year, even if the property never went up in value. And what I just shared with you is that the stock market this year has just gone down 6%. So so that's why people are moving their money out of the stock market and going into real assets, real estate, just like Ray Kroc did with McDonald's. So I don't know if I answered your question well.
Yes, I did.
Okay. So we're seeing people take money out of their 401ks, and put them into a self-directed IRA. We're seeing people borrow money, and because at the current interest rates, the rates are excellent, and so it's a great time to lock in low interest rates for a 30-year period of time. And that, quite frankly, is the most expensive part of holding onto the property. If you borrow money against it, is the loan. So people are locking it in. Our area is growing. The East Valley is expanding. We've got new colleges and universities that have moved in here. It's interesting if you drive through downtown Mesa right now and you see all of the students walking around because of the new college campuses that are there, and also out at Williams Air Force Base. It's pretty exciting to see what's going on. So I want to take this and get practical for a second. And by that, I mean, look, the future looks great for real estate. So what do you do? How do you take advantage of where we are and what our market looks like? And so if we recap what we just talked about, our rental market is really strong. The Phoenix area is continuing to grow. Our property values are increasing, and they're going to continue to increase because the supply of new homes has not kept up for a 7-year period with the growth in what we have, and demand is going up, so rents are going up. So the real estate investment makes even more sense now than ever. So how do we maximize those opportunities? How do we and what do we do if we have a property, or what do we do if we want to hold and purchase a property? What are our options? Interestingly, one of them is you can sell. And the people that were default investors, the ones that the market forced to hold on to a property for myriad of reasons, the ones that got out, we watched them bail out over the last few years because the values were starting to come out, and it's obvious that they got out too soon, and they left big money on the table. And so we've seen many investors who have implemented the hold strategy purchase those properties from the people bailing out and acquiring great real estate investments. So in fact, on our website, on my website, chaterteam.com, we have properties that are currently tenant occupied that people are wanting to sell. They're in good condition. They've got great tenants. The property management is already in place. And so, and they're wanting to sell. So these are creating some great investment opportunities for people. The other thing I wanted to talk about is updating the property. And if you watch HGTV and you see about flipping houses and all of the things that they do in flipping houses, it's pretty realistic in that there's always a surprise when you do it, and there's a huge upside when you're done. So our market has matured, and because we're maturing as a community. And so the newer homes are significantly different than the older ones. They use different colors, they have different fixtures, floor plans are different. They're far more energy efficient with the new ones. However, on the other hand, the older homes usually have the advantage of being located closer into where people want to work. And the renters typically desire a shorter commute time. In fact, I like to say that people will drive a lot farther to own a property than they will to rent a property. So we're seeing investors now updating their homes. And that's one of the reasons why we're seeing rents going up, because people are making the properties look newer and nicer, and they're getting a payback period where it makes perfect sense to do that. Let me give you a quick example here. This is a property in Gilbert that was renting for $1,500 a month, and it needed to be upgraded. The tile floors that were in there were chipped, and they were the 12-inch tiles, which were not fashionable anymore. In fact, you're better off to have carpet than a 12-inch tile in many cases. So we looked and we said, what are the costs of the upgrades? Well, in order to go in, do the cabinets, put granite countertops in, change the floors out, and the other things that needed to be done, it was about $22,000. But then we looked and we said, well, if we could raise the rent to $1,800, we'd have a $300 increase in that amount of rent. We also looked and said, it's going to rent more quickly. And so over a period of time, your vacancy factor goes down. And if it rents 1 month sooner and you get 1 extra month in rent, that's an extra $1,800. So I took a tax bracket of 25% because the money that you put into it, some of it could be written off. But if the property value was at $225 before, and this is real numbers, if the property value is $225 before, after we put the $22,000 in to fix it up, the property value now goes up to $275,000. So the return on investment just for going from 225 to 275 gives 128% return on investment. So why would somebody do this? Well, look, they get a better quality tenant, somebody that's going to take good care of the place because they're proud of where they are. They're also going to rent faster, and you're more likely to get multiple offers to rent that property. It increases the property value, increases the rent, and the interesting thing is, if you wait to do the fix-up on a property before it sells, you still have to spend that same amount of money, and you may wind up getting a lower sales price if the property is not done ahead of time. So what's the bottom line here? Bottom line is that our market is shifting, the demand is higher, and so taking the asset that you have and increasing the value of it by making it a nicer property pays off both in increased rent and also in lower vacancy factor and also in the appreciation and increased value of the house. We've got people right now that are actually going through and they're taking the older properties that they have and they're exchanging them into properties that will appreciate more quickly. And so they're increasing the value of their assets. And that's just like playing Monopoly. When you play Monopoly, the goal is to buy one house and rent and get higher rents, and then 2, 3, 4 houses, and then you do an exchange into a hotel. That's how you win the game of Monopoly. It's the same thing in real estate. Let me give you an example here. One of our clients just did this, sold his rental investment property that was older and it needed remodeling. And then, in fact, the tenant actually purchased the home from him. And so then he used a 1031 exchange, so he did not have to pay capital gains tax. And then he used those proceeds from this particular sale to purchase 2 newer homes. So a couple of reasons why it made sense. Because when the prices went down when the market went south on us in 2006 and prices went down, the older properties, they went down further during that, and it took them longer and they recovered less of their original value. The newer properties that were more attractive to buyers went at actually an 8.4% faster rate over that 5-year period of time, and it rents for more money. So he is getting a projected rate of return of 14%. 14% on the new properties by just moving the money from the existing investment that he had and upgrading the value of the investment. Any questions on that? Because that's a real live example. We just went through that. In fact, he's getting ready to buy another one now. All right. So we know that the future looks really good. If you hold on, you're going to benefit. If the goal is to obtain financial independence through investing, then there's no question that being an investor in the greater Phoenix market is a smart way to go. It's a good time. If you've got one, it's a good time to acquire another one. The prices are still good. They're still affordable. And you can benefit from these historically low interest rates. So I hope that that's encouraging to think about, you know what, the market's doing well, Phoenix is doing well, the investment property that you have here looks like it's going to continue to do well, and we can help you if you want to add on and buy additional properties, or purchase a property that has a tenant in it, or whatever your choices are. So let me stop here. Any questions?
No, thank you.
What would you say is the takeaway from this conversation?
Actually, I do have one question.
Yes.
Okay, now I have one of those older pieces of property, and we started with the remodel on the pool, and we were waiting because we have tenants in there that are happy, and of course we need to do an entire kitchen and bathroom update. Since the tenant's already been in there over 2 years, is it more valuable to go ahead and do this upgrade while they are in it? And, can I really raise the rent that much to get an increased rate of return on the investment, or would you wait until possibly selling it?
How long do you intend to hold on to it?
After your presentation, feel that it would be a good idea to continue holding on to it.
Yeah, I totally agree. Um, Somebody told me one time, he says, there's no reason to sell a property. You just exchange it into something that meets your goals. And
It is
because
meeting our goals right now, but you know that the old theory is you don't fix what's not broken, you know, and to turn around and just reward a renter for a $20,000 upgrade. I wasn't sure, how logical that is.
No, well, so based on what we've seen here, rents have gone up over the past couple of years. So I think it would be good for, and TCT will be happy to do a rental analysis to say, here's where we are today, and here's what the rents that we can get if on today's market, and here's what we may be able to get if the property is fixed up, if the work is done. So what I would do would be, I would say, okay, how much would it cost me to get this work done? And then what kind of additional rent can I get for it? So what's my payback period? What's my return on investment time? Because there's no question that there's no question that you can increase the value of the property. Let me go back to that little 900 square foot house that I looked at today. They bought that property for $114,000, and they did the fix up on the property and sold it for $192,000. Now, I'm not advocating that you sell the property. I'm just telling you that they bought it for $114,000. They put in probably $40,000 or $45,000, and they made an additional $40,000 or $45,000 over and above what they put into it. So answer your question quickly. Let's do a rental analysis on it, and let's see what it would rent for, what it's renting for today. Should it rent for more, number two, and number three is if we fix it up, how much would it rent for? And then we do a return on investment analysis. And if you can't get, let's say the return on investment for doing it is 10%. If you can't get 10% somewhere else, then the best place to put it is into the asset that you've got right now.
Okay. Okay.
You and I were talking at the very beginning. If you can find a property on a tax certificate, tax lien, you can get a 13% return on investment for that.
Right.
Right. So you kind of compare it to what can I get elsewhere.
Okay. Yeah, and that was possibly just a bidding down in my error. All righty.
So we're glad to help you do that. We're glad to help you do that analysis and see. But if you've had a tenant in there for 2 years, it's possible it'll rent for more. If it's only $50 more, then you don't want to get a vacancy because you can't make the $50 back. But if it's $100 to $200 more, you might consider it. So we can help you with that.
Yeah, definitely. And the other thing that I was holding up, I did not increase the rent on them because I was actually considering doing the remodel while they were in there. So for that inconvenience, there was no increase in rent, but the property would be rented as opposed to taking, a good 2 months to possibly 10 weeks for a complete kitchen renovation.
Yeah, no, I get that. If they're willing to do that, that would be something that have to be negotiated over and above the lease that you have.
Yeah.
Because you don't want them shutting your contractor out.
Yeah. So now we're at the point that one is all well, and we can progress on that one. On the average, I get 2 to 3 publications per week requesting me to sell that. So at this point, I don't think I would sell that, but I would consider investing in additional property and then continue my having TCT manage the property.
Yeah, that'd be great. In fact, if you have equity in that property right now, it's with the current interest rates, it's a great time to refinance it, and you can take the equity out of that one, put it into another one, and have 2 properties appreciating for you.
Okay. So now
So-
I need to just find the ideal piece of property.
Well, if you want us to look into that for you, there's great opportunities out here. We're more than happy to help you.
Okay.
Any other questions? Well, thanks for taking your time today. I appreciate it. And I'm excited for where we're going in our real estate market and the things that are happening, the growth that we're having here, and the benefits that it provides for each one of us. So thank you again for being here.
Thank you.
Thanks, Autumn.
No problem. Thank you, Steve.
Okay, bye.
Thank you very much.